Welcome, everyone, to this Directed IRA webinar and special podcast episode talking about the ins and out of the solo 401k. This is the #1 retirement account for self-employed persons. If I could use a solo K, I would, but I can't. We're going to talk about who qualifies for it, who should use it, how to set it up right, how to make your contributions, what are the pros and cons of a solo K versus using a self-directed IRA. Can I do Roth option or traditional? Can I do both? What if I have a spouse? What if I have a business partner? What are people doing? Can I take a loan from a solo K? Guys, we're going to hit a lot of stuff today because the solo K is freaking awesome.
Awesome sauce.
Okay, Aaron's here for comedic relief. The team here is, I appointed Aaron to be responsible for jokes today.
Mark's out of the office today, so I have the yellow rock star. So
yeah, someone's got to drink those.
We're covered with that.
Yeah, although I think those have a shelf life of like 5 years probably.
At least.
So,
all right. So we got one in our internal employee chat that I'll share. This one was pretty good. If your retirement account was filled with soup, what would you have? A broth IRA. Okay.
Yeah, it could also be a broth 401k.
Broth 401k.
Yeah.
Have your pick. All right, I got two more. These are.
You're gonna burn them all right now?
No, let me get one more. Let me get one more in. My wife and I have started aggressively planning for our retirement, and by that I mean we're playing the lottery 3 to 5 times per week. All right, I got a couple more towards the end.
All right, we'll pepper them in here. We want to, keep this fun and light. It's an important topic, though, of course, saving for retirement. We want to make sure you have a retirement account you're looking forward to when you hit that special age. So let's go ahead and share some slides. I want to give a disclaimer here. So this is meant to be educational in nature today, and that's why we do these webinars. We want to let you guys know the information, the details, the rules, what's possible in building wealth and growing your retirement account. So seek out licensed professionals, though, for your specific situations. Everybody's situation is different. We're just here trying to provide you educational content. All right, now let's go to the table of contents here on the next slide. These slides are going to get shared too. And by the way, today's webinar will be recorded. Mm-hmm. So if you miss any part of this or you want to share it with anyone else, it's going to be uploaded at directedira.com/webinar in the next couple of days, so you can catch any other parts of it, rewatch it again, relive the Aaron Halderman jokes, whatever you liked.
Whatever you needed. We do have some of the staff at Directed IRA joining us as well for you that are joining us live. So they're on, so you'll kind of see some of them answering questions. So if you want to pepper questions throughout the webinar, we'll stop and take some throughout. Just fire that over in the Q&A for us, though, so we can save those and share them with everyone else later as part of the notes at the end of the webinar. Okay.
All right. Okay. Let's go back to the last slide actually here. So here's some of the things we're going to cover. We're going to cover a lot of stuff I hit at the outset there, but we want to talk about new Roth rules for 2023 and beyond. Mm-hmm. Some of you might have a solo K and need updates on some of the rules. For any of you that are new to solo 401ks, there's actually some good things for 2023 and more good stuff for 2024. We're going to go over that. We're going to talk about contributing to it. Do you need a checkbook? Do you need an LLC for it? How do I qualify? What are common mistakes people make? And then how do I get more money into it in terms of contributions? So we're going to hit that and a heck of a lot more. Actually, we've got so much we're going to hit in today's webinar. All right, let's go to the next slide and just talk about what the heck is a self-directed solo 401k. Well, a solo 401k is sometimes called a one-participant plan. Like, that's what the IRS calls it. And it's essentially a 401k plan you can have for yourself. And so let's unshare the slides, Tristan. Just as a rule of thumb, if I'm talking forever, just unshare them, just so we're okay. I'm not on the controls, so I gotta give some cues. So forgive me, guys, if I do that.
I mean, we're in the professional studio.
Yeah, bounce it back, for a little variety, so people can see the slide. Cut off of it, whatever needs to happen. All right. Okay. All right. So the IRS calls these one participant plans, and it's kind of like, hey, if you're self-employed, we know you don't have a company you work for that offers a 401k. You are the company. And we want to let you do more than just an IRA, right? An IRA, you could put $6,500 a year into it for 2023. Mm-hmm. But in a solo 401k, guys, $66,000 for 2023. You can put 10 times as much money into a solo K than you can an IRA. It would take you 10 years of IRA contributions to put as much in as the maximum solo 401k contribution in 1 year. Okay. So that is a huge differentiation. And a lot of self-employed people are like, hey, I haven't had a retirement account for the last 10 or 20 years. I'm kind of behind. $6,500 isn't going to cut it. I mean, I'm sure I'll throw that in there, but what more can I do? And so that's where the Solo K is an awesome tool for any of you self-employed, because it's a 401k plan. And what you're able to do in it is because, you're such a great employee and you happen to be the boss in charge.
Only the best employee.
Yeah, you're the best employee. You're going to make it as generous as possible. You're going to max out every contribution trigger you can to get up to that $66,000 limit. That's why most people in their day job 401k won't hit that, because the employer's like, we're not going to let you do everything because that means we got to put in a lot of money. But in the Solo K, you're the employer and the employee. It's just what bank account is it coming out of, your personal account or your business account? It's your money at the end of the day. So it's super powerful because you can max out a lot of contributions. Okay, so now these are called, what are they called? So Solo 401k, if somebody call them Uni 401ks.
An NDK.
An NDK, one participant plan. Everyone's got a different name for it. So there's somebody that calls it what's it? EQRP. It's just a Solo K, guys.
That's a marketing made up
word. So these are all one and the same things.
Mm-hmm.
Now, here's the important part to this. You need to be self-employed with no other employees other than spouse, business partners, or other family, like kids that may work in your business, or even parents in your business. But if you have third-party employees that are full-time, and full-time is only 20 hours a week for up to a year, then you have to offer the Solo 401k plan to them. So a lot of people that use this are like consultants, people that have a side hustle, real estate agents who don't have other employees. They might have 1099 people.
Which is fine, yeah.
Which is totally fine.
Contractors, cool.
1099 contractors are cool. Those don't count as an employee. Or you might be like, hey, and I have lots of clients who are like, hey, man, I'm just starting out my business and I want to do the Solo K for the first year. Maybe I've got an old employer 401k. I left corporate America. I want to roll it into a new Solo K. And I want to use that Solo K and frankly take a loan out of it. We're going to talk about how you can even take a loan from your own Solo K, which you can't do from an IRA. That's another cool strategy. So everyone kind of comes at this from different angles, but remember, it's for self-employed people with no employees. Now, a common question we get on that, people are like, hey, Matt, I want to qualify for this. I love the Solo K. I have rental properties. Do I qualify? No, but there might be a workaround, okay? So if you have rental properties, rental income doesn't qualify as self-employment. And if many of you follow us for tax and legal planning or our Main Street Business podcast, rental income is not subject to self-employment tax. It's not self-employment income. Solo 401ks are designed for self-employment income. Like you're selling goods or services, you're getting commission. You have an eBay store, you're getting commissions, you're getting payment for goods or services, okay? That's all operational businesses where you can adopt a Solo 401k. If you're getting rental income, well, that's more investment income. The IRS is like, you don't make retirement contributions off of investment income. So you kind of think of your day job, and your 401k, your day job, they're withholding off of your wages and income. That's your ordinary income, not your rental property income.
Yeah.
So I fix a lot of these, and I've had to shut down over 100 Solo 401ks of people that set them up somewhere else, and are like, well, they said I could set it up because I have a rental property, and my rental LLC set up this Solo 401k plan. No.
Or I set that up with Fidelity on Fidelity's platform.
Yeah. And I just plugged in some numbers and in my information, and they did.
You qualify.
Okay. Yeah, I mean,
get one.
because they're saying you know what you're doing, right? And so, so remember, you've got to have an operating business. This could be a sole proprietorship going on Schedule C. This could be an S corporation. This could be an LLC that's flowing down onto Schedule C on your personal tax return. Okay, remember, you're selling goods or services, things like that. Now, if I do have the rental property LLC, you can do something called a side door Solo K. Not to be confused with a backdoor Roth IRA. We got
back doors, side doors, pick a freaking door.
Trap doors. We got it all. Okay. I don't know what the trap door is, but
we'll tell you all later.
Yeah, we'll come up with that one next.
That's a bonus.
So the side door 401k is if you do have rental properties in an LLC and you really want to do the Solo K, we can set up a management company, and you're going to push income from your rental property LLC over to a management entity. And this could be a sole proprietorship or just a single member LLC. And that management LLC is going to provide services to the rental properties. And so it can get income, which is now ordinary income, and now you can make new contributions to a solo K, and you can adopt a solo K plan. Now you're qualifying. Now, we never do a management LLC for clients for the rental properties. That's dumb, unless you're trying to do something like this to qualify some income or an opportunity to do a solo K. So look at doing a side door solo K if all you have is rental properties. Okay. Now, you could have a day job 401k, all right? Think of Dwight Schrute from The Office, right? He
Very successful
entrepreneur.
Yeah.
Okay. Now, we all know he's got a 401k at Dunder Mifflin, and Dunder Mifflin has their 401k plan, and Dwight Schrute could be participating in their 401k plan. But also, Dwight has Schrute Farms.
Very successful.
Very successful. He's making beet juice, doing weddings, right? He doesn't have any employees. He's got that little cousin of his.
Just him and his little cousin.
His little cousin who he definitely 1099s. Yeah. Okay. But Schrute Farms, whether it was a sole proprietorship or an S corporation, that could adopt its own solo 401k. And that's a really important point to think of. A business adopts a 401k plan, including a solo 401k. Individuals do not have 401ks. You have an account in a 401k plan, but you first have to have a 401k plan. Okay. And a business adopts a 401k. Microsoft has one 401k plan. They might have tens of thousands of employees that have an account in the 401k, but they have one 401k plan that Microsoft adopted for the benefit of its employees. The same thing with the solo K is your business is going to adopt a 401k plan for the benefit of its employees, and each employee will have an account. Well, that just might happen to be you or maybe a spouse. So that's kind of the basics on who qualifies, how it works. The business adopts it. You got to be self-employed, no other employees.
I do have a comment on that.
Okay.
Because we have some good FAQs on our website. So when you're setting up, you have a 401k with your current employer and you want to set up a solo K, you need to be tracking all your contribution amounts, right? So it's accumulating among all the 401k plans.
Yeah.
It is important. So you're not like double dipping.
Yeah.
You got to track all that throughout the year.
Yeah. And this is where you do want to get tax advice, So whether you're calling Directed IRA or Fidelity or whoever you're calling on a solo 401k plan, like you need to get tax advice separate from that. As a general rule of thumb, what Aaron's saying, it's your employee contributions to a 401k you don't get to double up on. There are ways you can double up on the employer side, but it gets a little complicated. Don't rely on it. It's not every scenario, but it's possible. So, but that's you need a tax lawyer or a competent CPA or accountant in that field.
And hang tight. I know we got some questions on some clarification on the max contributions. We're going to go through the totals of employee and employer contributions and give you some clarity on that. And then one other thing I'll say that is often overlooked that we have on our website as well, some key points we identified is on the qualifying side, you can have business partners and still qualify for the solo K. Oftentimes you're like, it's just me and my spouse and my kids, whatever. You can have business partners as well. It's just not those full-time employees or another business typically where you have full-time employees, and we'll touch on that.
Yeah, that's a problem area. So, because we do get that one quite a bit. Hey, I've got a business with employees, but I've got another company where I don't have employees. Can I do the solo K plan in the company I don't have employees in? No. The IRS says if you own any company 50% or more that has employees, you won't be able to do a solo K. So any company you own 50% or more that has employees, you will not be able to do a solo K. All right. Now, let's say, though, you're a 20% owner in a business. There's 5 partners in a company, 20% ownership, and you have a separate business that has nothing to do with that company with no employees. Well, you could do a solo K in that separate company you own 100% that has nothing to do with this other business. Now, you can't be like, well, my 20% is owned by my S corporation and it owns an LLC with 5 partners, and I'll do a solo K in my S corporation. That doesn't work. But if you do have separate businesses, and the one where you do have employees, you're less than 50%, it is possible to solo K. Now, this is why it's important to make sure you're setting it up right. And when you set it up, our law firm at KQS Lawyers, our sister law firm, we work a lot together, of course, KQS Lawyers and Directed IRA, we set up the solo 401k plans in our law firm. You talk to a tax lawyer who goes over your situation, and you can go through your scenario to make sure you're qualifying and doing it right. How much can I contribute? How does it work? Like, that's all handled by a tax lawyer. You can get those questions answered. So,
while we're on this topic, look, before we switch gears, let's hit on one. Ashish asks, what's the maximum ownership I can have with a business partner with no employees to qualify for this?
I mean, 49%. But you better really legit be 49% and not just on paper to qualify for this. So that'd be the technical answer.
There you go. And then going back to another business that I have with partners, okay, that has full-time employees, is it, what if it was like me, an LLC, maybe a spouse, and then 3 other partners? How's the percentages weighed in there?
Your spouse gets attributable to you. So it's called the controlled group rules. And so you're over 50. So that if that LLC with those 3 partners, you, your spouse, and some other person, it has employees, you're not going to be able to do a solo K anywhere.
Yep. Okay.
All right. Now, there is an interesting spouse exception, though, for spouses that have one of them has, and they're separate businesses. They're both self-employed. One of them has a business. Let's say one spouse is a dentist with 15 employees, and they own their dental practice 100%. And whether they have a 401k or don't, let's say there's the other spouse is a real estate agent and has nothing to do with the dental practice, totally different businesses. And the real estate agent's like, hey, I want to do a solo K. Well, you could do that. That spouse that has the real estate business, real estate agent, could do a solo 401k. But the spouse over here with the dental practice couldn't. So there is a rule that if the spouses have separate businesses that are not connected, then you can get away with it. So, and that the spouse that doesn't have employees could still do a solo 401k.
Love it.
All right, let's share some of these slides now and get into the contribution rules. So, all right, now here's the cool thing. Guys, this is awesome. I think this is awesome. You could put more money in your solo K for 2024. So right now, I mentioned earlier, for 2023, you could put $66,000 into a solo 401k. In 2024, it goes up to $69,000. Now, the way that works and how you get to that $66,000, let's just talk about 2023 for now, is a combination of 2 contributions. Now, when everyone thinks of a solo 401k or just a 401k in general, remember, there's 2 ways you put money into this: employee contributions and employer contributions. You know, if you've ever had a job with a 401k, you put some money in, the company you work for may put some money in and do a match. And so those are called employee and employer contributions. Now, there's a formula that's different for both. Let's talk about employee first. Employee for 2023, you can put $22,500 in as employee contributions. Now, the rule on the employee is, as long as you make the amount you want to contribute, you can put it in up to a max of $22,500. So, for example, let's say you made $100,000 a year. And that's your W-2 or Schedule C net income in your small business. Okay, this is your company, of course. You made $100K. Well, you could put in $22,500. Okay, let's say you made $10,000 though. How much can I put in as an employee contribution? $10,000. You can put in the dollar amount of what you made up to a max of $22,500. Now, if you're 50 or older, you get an extra $7,500 you got to put in. So you could be putting in $30,000 of employee contributions. Again, as long as you made $30,000 for 2023.
Which is pretty sweet, because even if you just made like a small amount in that side hustle that qualified you for that solo K, you can still get more than that soon to be $7,000 with a traditional Roth. That's freaking awesome. That's cool.
I mean, and especially when you get to add in the employer contribution next. So let's go to the next slide that has the employer contribution. Okay. An employer contribution, we have 25% of your W-2. If you're an S corp, you take a W-2, and that's what your contribution is based on. If you're a sole proprietorship, it's based on your net income on Schedule C. So let's go over W-2. That's the most common. Most of our small business owners, we love to be in S corporations. It's great self-employment tax savings. Again, get to the law firm to set up your solo K. You come back over to Directed for your solo K accounts, of course, but they can go over that strategy if you don't know that and the S corporation. But here's how it works on the employer contribution. Let's go back to the 100,000. You made 100K. You put in 22,500 employee. You also get to put in 25% of that 100K as an employer contribution, 25,000. So I got to put in 22,500 employee plus 25,000 employer. So I've got a total of 47,500 I got to put in as 2023 contributions off of 100K. Now let's say you took a $50,000 W-2. Again, 22,500 employee, because you made at least that, plus 25% of 50,000, which is 12,500. So now you got to put in, what is that, 34,500 is what you, or 35,000?
I was hoping you were going to be
22,500, 12,500, yeah, 35,000.
I was hoping you were going to be Brad Pitt and Jonah Hill from Moneyball, and you're going to point to me and tell me, like, what's the math calculation on that? If you haven't watched that movie, great movie, Moneyball, Brad Pitt, Jonah Hill, there's a skit in there.
Yeah.
It goes over that.
So that's pretty sweet. On 50K, I got to put in 22,500 plus 12,500 for that. You got to be ready.
No, I forgot.
35,000. 35,000. Okay. So that's awesome. I mean, this is why it's even better than a SEP IRA, because if you had just a SEP IRA, you can only put in the 25% of that 50. You don't get the 22,500 plus it. So if I only had 50,000 as a W-2 and I wanted to do a SEP IRA, I can only put in 25% of 50, 12,500. Well, I could put in more than double that if I'm doing a solo K instead of a SEP IRA. So that's another rule and why, we've always, loved the solo K over the SEP IRA, is because I can get more money in on a lesser income amount. All right. Okay, so that's how you get to the 66K. Now, if you do, if you're a sole proprietor or you're doing Schedule C, instead of 25%, you only do 20%. All right. There's a whole worksheet you can fill out with the IRS on how you calculate that, but basically what it boils down to is 20%. So let's take those same numbers. You made 100K. Net income on your Schedule C, you can do 22,500 employee plus 20% of the 100K, 20,000. Now you got to put in, what is that, 42,000?
42,500.
Yes. That one was easier. I'm going to wait for a hard one. That one was easier. Okay. So that's how it works on the sole proprietor. And you want to be making these contributions. You can make them through the year. And the deadline for the contribution is your filing return deadline, okay? So let's say you set up the solo K right now, okay? We're at the end of 2023, but you're like, I don't want to make the contribution yet. You don't have to put it in right now. You could put it in up to your tax return deadline, which if you're a S Corp is March 15th. If you're a sole proprietor, Schedule C type thing, that's April 15th of the next year, okay, of 2024. Now, if you're an S Corporation, you do have to do a W-2, and you need to note your employee contribution on your W-2. So you do need to pre-plan for it a little bit, at least by the end of January of 2024. But the cool thing is you don't have to contribute it. You get up until the tax return deadline for your business to make the employee and the employer contribution.
Which is cool because we got the holidays coming up and we have like a solo 401k special that we'll talk about at the end if you want to get going on that. But you're not like, don't have to stress out about getting it all done by year end to get your contributions in. Yeah. So like that's like a common myth, I would say. Yeah.
Now, here's another important thing on the solo K. Sorry, there's just like so many little facets to this.
There's a lot.
And honestly, don't get overwhelmed by it because it's just options. That's what's cool about the solo K is there's just a lot of options. You don't have to do all these things, but here's an option. You could do all Roth dollars if you wanted, okay? And this is brand new for 2023. So if any of you have had a solo K in the past or looked at it, this is a new rule. You can do all Roth contributions up to that $66,000. The old rule used to be only employee contributions, that 22,500 could be Roth. The employer, the rest of that balance up to $66,000, which is
Wait, from the 22.5 to
66. That was harder.
66,000.
Pull out your calculator.
Hold on, let me get my calculator out for that.
Okay,
that would be 60.
The rest of that amount, okay,
37.5.
37.5, okay. Is that right? 22.5
minus 66.
minus 66. Okay.
Yeah.
All right. But the employer contribution, the rest amount
43.5.
43.5. Okay, that sounds right. Okay. Okay, that 43.5 used to, this is before 2023, had to be traditional. You didn't have a choice. But now in 2023 forward, that employer contribution can be Roth if you want. So you get a pick. You could do a little bit of traditional, a little bit of Roth. You can pick all Roth, all traditional, whatever you want. And a lot of clients from a tax planning standpoint at the end of the year, like, I'm going all traditional. Mm-hmm. I don't want to pay the IRS anything right now. I want all the tax deductions I can get right now. Cool. The IRS will get you later, right? Because this is traditional dollars. It'll come out and you'll pay tax on the way out. But it will save you taxes now. So we get that. Other people who are more disciplined are like, nah, I'll pay the tax now because I'm going to grow these Roth dollars to a larger amount later. And then when I retire, I won't pay tax on the way out. So, but you get a pick. And that's the thing why I say it's options. You get to pick what you want to do. And you could even mix it up a little bit. And sometimes you might have a year that's a higher income year. And you're like, I need traditional this year. And the next year is like, I'm going to do Roth this year. I don't need the deductions. I don't know. You could pick and choose. Now, you must have separate accounts for those things, okay? You must account for that money separately. If you do Roth dollars, that's a separate Roth account. And when you're using Directed, we do a custodial service for these accounts where we track all this stuff for you, statements to your tax reporting. If you have to do a 5500 EZ, 1099s, if you're doing conversions or distributions, we're going to talk about that here later. But most of our clients that do a solo can end up using Directed to do custodial accounts. You don't have to, but you will do that.
You got options.
Again, you got options. And so in the solo K, if you're doing Roth and traditional dollars, no matter how you're doing it, whether you're using Directed or you're doing separate bank accounts, you got to track those and keep those monies separate, traditional dollars and Roth dollars. And if you do if you have a spouse in your solo 401k who works in your business, they would also have separate accounts, okay? And if they're doing Roth and traditional, they'll have a Roth account and a traditional account. I mean, you could have 4 accounts in the solo K just between spouses where it's, each of you have a Roth, each of you have a traditional.
Let me pose a question, but let me make a comment first. Some of you are kind of confused, like, well, do I have to set up a self-directed IRA? You are self-directing your solo K. Like that has could have a traditional and a Roth component. So that solo 401k can still invest in real estate or be a private lender, do all those same things that you would hear when you're just talking about self-directed IRAs. So same type of deal applies for investing in alternative assets other than just stocks and mutual funds. Okay. The question is, if the contribution was 100% Roth, do the net income minimums and W-2 rules still apply?
No. I don't know net income minimums and there's no income restrictions in Roth 401ks. Basically,
essentially asking.
Yeah. So there's no income restrictions on Roth 401ks. Now in Roth IRAs,
there is.
Many of you are familiar. There's a high income restriction on Roth IRA contributions. If you're a high income earner, you got to do a backdoor Roth IRA. We do those all day long here. I have a separate webinar on the backdoor Roth IRA. I do a backdoor Roth IRA every year. But the solo 401k Roth or even your day job 401k, if you're doing Roth, there's no income restriction on it. No limitations there.
Cool.
All right. Well, let's based on that other question, and this is perfect on the next slide too. Let's look at the account guide that kind of separates and shows some contrast between solo 401k and self-directed IRA. And like Aaron said, just like your self-directed IRA can own real estate or do private money lending or invest in a private company or fund, your solo K can do the same thing. And see, the self-directed part of it is just you're at a custodian and have an account where you can buy alternative assets like real estate, private companies, LLCs, lending, all that stuff you can do. See, I can have an IRA at Directed IRA or a solo K at Directed, and I can do self-directing, just like I can have an IRA at Fidelity and a solo K at Fidelity. But if I have an IRA at Fidelity or a solo K at Fidelity, what do they let me invest in? Brokerage products, because that's what they are. They're a brokerage. So they let you buy stocks and mutual funds and the stuff that they sell. So it's the same concept here in terms of self-directing. You can self-direct a solo 401k. You just need to get a provider or have the plan set up that allows for those self-directed access. If you set up a solo 401k, and let's say you set it up at Fidelity or TD Ameritrade, we have lots of clients who come to us with that. They're like, I already have a solo 401k. I've been doing this for a while, but yeah, I want to do real estate. Cool. We are going to do what's called a restatement of your 401k plan. We're going to keep your 401k plan. You already set one up, but we have to restate it onto our pre-approved plan document with the IRS, which KKOS Lawyers has. And that pre-approved plan document allows you to buy real estate and do all these alternative assets. So it's still your same 401k plan, but it gets a restated plan document for self-directing. So that's how you get over to self-directing from, let's say, a brokerage if you already have a solo K. All right. Let's go back to that slide, though. Sorry, let's pull that back up because there's a lot of differentiation.
We'll just hammer through all of them.
Yeah, let me just go boom, boom. Okay, remember, a solo 401k, you must be self-employed, okay, with no employees. That's how you qualify for a solo. Self-directed IRA. IRA is an individual retirement account. You just have to be an individual. That's it. Okay, and you can have one. Contribution limits, you can put 10 times more into a solo K than you can an IRA. IRAs, by the way, are going up to $7,000 for 2024. Pretty exciting annual contribution.
And $1,000 catch up if you're age 50 and over.
Yeah, that's great for those 50 and older.
8K, baby.
Custodian requirement. In an IRA, you have to have a custodian. Okay. The rules for IRAs require you to have a qualified custodian that's a bank, a credit union, or a trust company. At Directed IRA, we're a trust company, licensed, audited by the banking department and all that. And that's an IRS requirement in order for your IRA to qualify. Solo 401ks and 401k plans in general, on the other hand, the business owner could be the trustee and plan administrator. You don't have to have a custodian of it. And so for the most part, our clients, the business owner is the trustee and administrator of the 401k account, the solo 401k. Now, they may open accounts at Directed, and that's the most common. We're going to get to that on your options. Once you have a solo 401k plan, what do you do with the accounts and tracking the money and investing it? Most of them will use Directed for custodial accounts on these to help track it, but you don't have to if you don't want to. Again, there's options, okay? And we'll hit that a little bit later. Rollover limitations. So the one catch that we sometimes have in solo Ks that's different than IRAs is if I have a Roth IRA, let's say, and I'm like, oh man, I'm self-employed. I want to do a solo 401k and do Roth dollars. Can I roll my existing Roth IRA over to my solo K? I'll open a Roth account in my solo K. Could I roll my Roth IRA over? No, you cannot. Roth IRAs are always Roth IRAs. Okay, you cannot move a Roth IRA into anything else but another Roth IRA. It's just a weird Roth IRA rule. Now, let's say you're like, well, I have a traditional IRA, Matt, and I'm going to do a solo 401k. Can I roll that traditional IRA over to a traditional account in my solo K? Yeah, traditional is fine. It's just the Roth IRA is the one little quirk every once in a while that pops up. Let's see, loans. In a solo K, and you can unshare the slide, everybody has them there, but loans on a solo K, you can lend yourself money from a solo 401k, half the balance, not to exceed a total amount of 50K. You can't loan yourself money from an IRA, all right? So solo Ks are cool because if I did want to access the money for whatever purposes, and a lot of times we have clients, new business owner clients who are like, all right, let me set up my new S corporation for my brand new business, roll over my day job 401k I just left of $200,000. I'll put it into my new solo K for my new business, and then I'll lend myself $50K to help cover startup expense or living expenses as I'm starting up the business and trying to earn income. And because I can take that out of my solo K and it's not a distribution, I'm just lending it to myself. And then you got to pay it back over a 5-year window. The interest rate is prime plus 2. Do you know what the prime rate of interest is right now?
Isn't it 7?
8.25. Oh, okay. I was updating the slides from 2 years ago. The prime rate of interest from I think 2 years ago was like 1%. And we're like 8.25 right now. So the rate you charge on the solo K is 2% on top of prime. So if you lend yourself money from your 401k, it's called a participant loan. Again, you have to balance, not to exceed a total of 50K. You're going to pay prime plus 2, which right now would be 10.25%.
I'm Brad Pitt this time.
I should have floated you that one. That one was easier.
No, that's a lot, though. Just remember that that's like, you're setting up that business. We have on our FAQs, that business purpose should be to earn profits and pay yourself wages. And it's not, again, just for passive income purposes. It's an operational business.
And it has to be a real business, because this is another thing we run into. Other competitors in the space that frankly are just selling crap and they don't know what they're doing. They're like, well, just set up an LLC and then you can have a solo K. Well, that LLC has to be doing some business. Mm-hmm. I don't care if it's a lemonade stand or you're selling on eBay or driving Uber. That all qualifies, by the way, but it better be doing something, okay? So you can't just like set up an LLC and have nothing go in it. Eventually that hits what's called the hobby loss rules, and that entity doesn't qualify, and therefore the solo K won't qualify either. So it's just got to be a legitimate business, but it could be a brand new business. It could be like, I'm a brand new real estate agent. I'm driving Uber. I got a side hustle. I'm doing construction on this. I don't know, whatever you're into, whatever your small business is on the side, it doesn't have to be making a lot of money. It just has to have some income.
I got one for you.
And it can even be losing money the first few years, which is fine.
Yeah,
but eventually you will need to show a profit.
Because this came in the question, and we get it in our live events as well, always from a live audience member. Difference between UDFI and UBIT.
Okay, great question. All right. Okay, UBIT. I'm just trying how far I want to get into UBIT. I want to make sure everybody understands what that is.
Yeah.
Unrelated business income tax. Remember retirement accounts. One of the great things about all retirement accounts, IRAs, 401ks, doesn't matter. One of the great things about retirement accounts is when you make income in it, it's not taxable. The IRS has said, use these accounts, and when you invest them, they can grow. We don't charge taxes. You're making money in the account. Excuse me. Now, if it's a Roth account, it's going to come out tax-free. If it's traditional, we're going to tax you later on the way out. But as you're making money and growing that account over 30, 40 years of investing with a retirement account, you pay no tax as you're growing it, as long as it's investment income. If it is business income under the rules, you have to pay tax. That tax is called unrelated business income tax or unrelated business taxable income, UBIT or UBTI. That tax rate is 37%. Now, generally, we're going to try to avoid that in self-directing, whether this is IRAs or 401ks. So, for example, let's say you're buying real estate, rental income, investment income, interest income, I'm lending on real estate, investment income, capital gain income, I sell stock or a private fund or a startup or real estate or a wholesale contract or an option, capital gain, investment income. It's exempt from UBIT, okay? Now, if your IRA or solo 401k is out developing real estate, all right, or it owns a small business that doesn't pay corporate tax, like through an LLC, where it's a pass-through of business income from the LLC to your IRA or 401k, you will pay this UBIT tax of 37%. Now, make no mistake, UBIT applies to solo 401ks. There's some dummies out there that tell you there's no UBIT in a solo 401k. That's totally wrong. They don't know what they're talking about. There is an exception for solo 401ks to something called UDFI, which is a small version of UBIT, and we're going to talk about that in a second. But UBIT applies to 401ks and IRAs. So you got to make sure, whether it's a solo 401k or a self-directed IRA, you're getting investment income. Okay?
Love that.
All right. Now, UDFI. I don't know why I'm trying to explain this in a 3-minute answer. It's a whole chapter in my book, guys, and
but you're doing it.
We've done webinars on it. Yeah, I'm going for it.
This is good.
I'm trying.
Yeah, this is good.
UDFI, on the other hand, is, let's say, well, let me say UDFI. Basically, when you use retirement account dollars to buy an asset, that's when you're not paying tax. If you say, hey, I want to use the money in my retirement account plus go get a loan of money outside of my retirement account from a bank or a third party.
Private money person.
Yeah, private money lender or a non-recourse lender. We have a number of banks that lend to retirement accounts to buy real estate or stuff like that. The IRS is like, cool, go do that. Make sure the loan complies with the rules. It's got to be what's called non-recourse. But you want to leverage your retirement account's investment with debt? We'll let you do that, but you got to pay tax on the profits from the debt piece. Okay, there's a way you have to calculate that. The more debt you have, the more profits will be subject to that UDFI tax. Now, UDFI is a version of UBIT, UBTI. It's a different way of catching UBTI. Now, if the debt is on leveraged real estate, you're buying a rental property, or for example, with an IRA, you will pay this. If you're buying a rental property with a solo 401k, you will not pay this. Okay. For example, I use a 401k account. It's not a solo K, but I self-direct my 401k in the law firm. That is possible to do that, by the way. So if some of you do have employees and you want to self-direct, it's a lot more complicated than what we're talking about today. It's possible. It'll probably cost you $10,000 in fees, but you could do a 401k plan. Our law firm at KKS Lawyers sets those up, and you can have an account for you or any employees that want to self-direct within the 401k. Okay, a little more complicated out of scope today. We'll do a webinar next year on that for any of you that have employees, or call the law firm, KQS Lawyers, kkslawyers.com. You can get a consult with one of the tax lawyers. We do set those up in the law firm. Okay, sorry.
That was good.
I bought real estate with I bought a rental property with debt in my own 401k. I didn't have to pay UDFI because it was from a 401k. So this could be your solo K. You can leverage with debt. So that's a difference between an IRA and a 401k is no UDFI. Okay. Now, is there anyone on the webinar still?
No, there's a ton.
After that question, sorry, I was like, dang.
They all hung in there because
all right, thanks for hanging on that.
It's important. There's a lot of misinformation. That's why we do these special webinars and podcasts to clarify some of the misinformation out there.
Yeah.
It's tough.
Someone's got to do it.
Yeah.
Okay, let me hit a couple things that are important too on just kind of like record keeping a solo K. So there's a number of areas where there's some tax stuff that has to happen on a solo K. When you're contributing, okay, this has to be part of your payroll if you're an S corp. Okay, your payroll company or your accountant that does your payroll for your S corp needs to know. It's got to be on your W-2 at the end of the year that you made this contribution into the solo K. When you make an employer contribution or a match, your accountant needs to know this. It needs to be in your bookkeeping because that's an expense. That's a deduction in your company that it needs to be on the company's return. Okay, so make sure you're coordinating with your accountant and you know how to do that. It's very common for accountants to know this stuff, whether it's self-directed or not, solo 401k or any of these retirement accounts. There's a pretty straightforward process and guidance from the IRS on that. So, but that's on you to basically track those contributions with your account because this is happening at your business level. This is happening in your business accounting and the W-2 payroll reporting for your company. Now, let's say you put the money in your solo K account. Let's say you did Roth dollars, okay? You threw in some Roth dollars and you have a Roth account in your solo K. You threw in $20K for the year. Let's just say you just wanted to get $20K in there. It's
going to be another math problem.
No, I'm going to keep it simple. Okay. Try get ready. Okay.
I was getting ready.
I like it.
All right.
So you got $20K Roth dollars in there. All right. Now you would have needed to tell your payroll company, even though you don't get a tax deduction, your payroll company needs to know that. It needs to be on your W-2. It's not going to reduce your taxes because it's Roth, but that's still on your W-2. And but let's say you want to make traditional dollars later. Okay. Now you need to open a separate traditional account, and let's say the match you want to do is traditional dollars. Let's say you made $50K again. So you got 20 in Roth, and you want to do the match on traditional dollars. So I can do 25% of $50K. That's
sorry, I was
$12,500.
reading some questions.
I was trying to get you when you weren't paying attention.
I knew you would.
All right. Okay. So that $12,500, that's going to go in as a company contribution. You take a deduction. But let's say later on you're like, I should convert that to Roth. Okay. You can do a Roth conversion of those traditional dollars up to your Roth. That'll take a 1099-R though. Or let's say you hit 59.5 and you want to take distributions. There's another 1099-R. Okay. So any Roth conversions or distributions, there needs to be a 1099 issued. If you have your accounts at Directed under what we call our custodial account for this, we do those for you. If you don't and you're kind of doing it on your own, which you can do, make sure your accountant or somebody knows what's going on and they're doing that tax reporting or that you're doing it because there is tax reporting that still needs to happen. Now, the last thing, and this is unique for a solo K in terms of tax reporting, there's something called the 5500 EZ, and this is in the chart on the slide. It's called the 5500 EZ. This is a return for the solo K itself. A solo K has to file a 5500 EZ every year only when it has 250K of assets or greater. So if this is a brand new solo 401K, you probably don't need to do a 5500 EZ, okay? But let's say once you get up to 250K in it, either you rolled over money or you've been making contributions and investments, you have 250,000 of assets, you have to file a 5500 EZ every year to the IRS. And there's $10,000 penalties for failure to file this stuff. There's no tax due on this return, but it's an informational return the IRS makes you do. It's called 5500 EZ. Now, again, if you have a custodial account with Directed handles this and does it automatically for you once your account value hits over $250K. Now, that's for all accounts, by the way. So if you've got an account, your spouse has an account, combined, it hits 250. The solo K has to do the 5500 EZ. All right, any questions we want to hit?
Well, let me say this: there's no way we're going to get through all the questions. We try and answer as many as we can when we do these live, especially. But let me say this: if you'll go to directedira.com, and in the upper right it says "Schedule New Appointment," or directedira.com/appointment. You can schedule a free 15-minute getting started call with one of our solo 401k or IRA senior account executives. And the purpose of that is to answer questions to get started with opening up a new solo 401k or self-directed IRA. And you can fire away with those questions there. They're well equipped for it. Some of them are on answering them, but just want to set the expectations. I love it. They'll put one at the top and then just copy and paste and throw it again and again. But we'll get to as many as we can.
Yeah, we'll try. If you do that 4 times, we will then read it.
Just copy and paste 4 times. We'll get you.
I'm just kidding. That probably did not. Aaron's like, thanks a lot. The Q&A.
You know what Prime is? And we'll just clarify right now since we do this live. It's 8.5%.
8.5 now. Okay.
8.5 as of November. We were traveling this past week, so forgive us, but 8.5.
That's nasty.
So plus 2 is
10.5%. Do you want me to speak? Okay. When I point at you, yes. Okay. All right. Let me hit a couple other things for the next 5 minutes. Then let's just take questions. We'll just rapid fire questions for the last 5 minutes. I want to talk about a couple other things that come up. One is, all right, Matt, I want checkbook control of the solo K. Do I need an LLC? No, you don't. We have some diagrams in here that kind of show you can use an LLC if you want on the slides. I'm not going to show them here, but just they're in the slides there if you want to see. You can use an LLC. You don't have to, though. With a self-directed IRA, if you want checkbook control, you have to do an LLC. All right, it's called an IRA LLC. We have separate webinars on it. It's a chapter in my book. Lots of content on that at directedira.com. But in a solo case, since you're the trustee, you can set up what's called a trustee-controlled checking account. We use Titan Bank. Great. They understand what these are. And your solo K plan and your account within the plan, let's say you have a Roth account, it will have its own checking account. If you're like, well, my spouse has an account too. Okay, your spouse's Roth account will have its own checking account. You still have to keep these separate, okay? But you can have a checking account for any account within the solo K plan you want without having to have an LLC. These are called trustee checking accounts right out of the solo 401k itself.
And we have the applications on our website. If you go to our resource directory or the Solo K page, we have that outlined how you could get started with one of those bank accounts. Super easy to do.
Yeah. Now, you can use an LLC if you want, but you don't have to. So you could use an LLC. Maybe you wanted to partner in your account, your traditional solo K account, your Roth solo K account, your spouse's solo K account, their Roth, for example, those 3 accounts all into one LLC to go do a deal. You could do that, all right? Some people like the LLC just because it's easier to transact with. If they're doing stuff at the courthouse steps or with title and escrow, they just understand that XYZ Investments LLC better than they do this trustee checking account structure. So you could use the LLC structure, though, if you want. So I'm just saying you don't have to for checkbook
the limited
control.
Liability protection on there. If that's
right, you still have the asset protection of the LLC, which is nice too, because it protects the solo K from other liability. Okay. Another question that comes up is RMD. Now, there's been some rule changes on this for 2023. In a solo 401k, and this is 401k plans in general too, but in a solo 401k, once you hit age 73 now, that's the new age, and it adjusts a little bit every year. But at age 73 now, this has gone from 70 and a half to 72. We're at 73 now. This is RMD age. At age 73, your traditional 401k dollars in the 401k are subject to RMD. Now, a lot of people will say, well, Matt, I'm still working in the business. I heard there's an exception for RMD when you hit 73, as long as you're still working. And I'm still working in the business. Do I get that? Nope. There is a rule that says owners and highly compensated employees do not get to use the exception for taking RMD at age 73. So be careful Googling this and stuff because you might get that answer, but it doesn't work for solo Ks. Okay, so for solo Ks, your traditional dollars will be subject to RMD. Now, Roth dollars and solo Ks used to be subject to RMD as well, but starting in 2023, now there is no RMD required for Roth dollars in a 401k.
Big win.
That was a big win.
Big win.
Yeah, that just keeps it simple, and frankly, it makes sense, right? Just like Roth IRAs, there's no RMD. You don't have to start pulling money out of a Roth IRA when you hit age 73. You can if you want, starting at 59 and a half, of course, but you don't have to. You keep investing the whole thing, if you want to start taking when you're 80, whatever, So just no RMDs. Traditional, you will have that at age 73 or whatever the RMD age is when you hit those golden years. But the Roths are now
the golden years.
Yeah. I just was throwing that out there in general because everybody's a little different on what they.
Hey, I do have one for you, Matt. On the Roth distributions after age 59 and a half, of course. Does that still require a 1099-R to be filed?
It still does require 1099-R, but it's not taxable.
Cool.
Let me hit a couple deadlines, though. I mentioned them briefly. Okay, right now, if you set up a solo 401k, and let me go to the last page on the slides here. Just go to the last page on the slides. I want to if you're thinking about doing a solo K for 2023, start now. Okay, start now. Don't wait. Start now. There's a couple of reasons why we want you to do that. One, you save $100 in the law firm for setting up a solo 401k. If you're using an attorney, you get to talk to an attorney. They go over your situation, make sure you qualify, answer all your questions. How do you contribute? What's best in your situation? Okay, you get all that done. You talk to a tax lawyer. You get it set up. You have the self-directed, pre-approved plan document, and then you save $100 right now to get it done. Now, as long as you're getting it done now and you have it done within 2023, you're cool to max out your 2023 contributions, no matter your situation. All right, as long as you have the income, of course. You're also going to save $100 right now because we have a special for this at Directed as well for any of your custodial accounts. Okay, and so when you first set up your plan, this is kind of step one there. Go to the next slide if you don't mind. You have to set up a pre-approved plan. Okay, there's a fee for that. Solo Ks have that pre-approved plan document. Like I said, it includes a console. Then you have a custodial account that we would set up at Directed. You don't have to do this. You can do our annual compliance plan. I'll talk about that in a sec. But the custodial account option is we do statements. We track your stuff for you. We'll do your 1099s for distributions or contributions. We'll do your 5500 EZ when you're at 250K or more. Like, we're helping you track this. And particularly for new people who don't know what they're doing, this is the way to go. Okay. If you know what you're doing or you got a good account that's going to do this for you, you could skip this. And you could do what's called the annual compliance plan, where you track it all separately. And you're going to have your accountant involved or someone else, or maybe that's you. You're good at bookkeeping and tracking this, and you just rely on us for annual updates to the plan. Because there are plan updates that are required at least every 6 years, which we will issue to you for your plan, whether you're on a custodial account option or the ACP, the annual compliance plan. But there's a different fee for those. And again, there's a discount right now of $100 for any account under Solo K for a custodial option. And then it's $100 on full service in the law firm for setting up a Solo K. $50 off for docs only. Now, the reason we do this now in November is because all of you wait and you call us in December. And the IRS shuts down for the last week in December, conveniently. And so we can't get stuff set up. I've got to go get an EIN for your solo 401k.
It's not even our fault at that time.
And everybody's rushing at the end of the day. And we got employees that don't want to work on Christmas. And so we try to get you done in November. That's why we do this special right now. Now, you can come to us in December, and we'll try to get you through. So now, for you that are sole proprietorships, you could do it after January and even in 2024 up until your tax return deadline and still make 2023 contributions. It's possible to do that under the new Secure 2.0. But I say if you want to do it, just get it done now. For any of you S Corps, though, you don't have that flexibility. Okay, you'll be able to make your employer contributions, but your employee contributions go out the window. Let's get it set up before year end. You've got to have it set up before December 31st if you care to make 2023 contributions.
Love it.
Okay.
Tristan, throw up the slide before so everybody can see that again. And we will have the recording available plus all the slides and even some that we didn't share. We go over some of those diagrams, and then you can download that. We'll have that up tomorrow or the next day. Cool.
All right, so that's where to go to get started. DirectedIRA.com, we have a solo K page, or to KQS Lawyers, you'll see the start now and the discount at the homepage of KQS Lawyers. Like Aaron said, go to DirectedIRA.com and schedule a new account appointment at the top of the page, and you can get an appointment with one of our
Senior account reps.
I was searching for the word there.
I got it.
Senior
Account reps
okay.
or a solo 401k specialist.
Yeah.
Choose your adventure.
Yeah. So we have an awesome, amazing team. Okay, questions?
Can I roll over funds to my solo 401k?
Absolutely. Remember, the one hang up is Roth IRAs. Even if you have a Roth account in the solo K, Roth IRAs cannot get rolled into 401ks.
Okay, let's see.
Now let me see while you're looking.
Yep.
You can go out. Like, let's say you have a Roth 401k. You can go out of a Roth 401k into a Roth IRA. You just can't go Roth IRA to Roth 401k. That's the tax code for you.
Ooh, I like this one. This one's interesting. Okay, Chad asks, I have a business that's seasonal. So I have seasonal employees for about 5 to 6 months. They're given W-2s, work approximately 24 hours a week. Again, this is only from May to October. Could my business adopt a solo 401k?
Yes. You most likely could. There are rules that say if someone is a part-time employee and over a 3-year window, so they stayed with you for that long, they could qualify. This is a new rule starting in 2023. But I would think you probably have enough exceptions there. I don't think that seasonal would qualify. The only caveat I would say is if there's someone that stayed with you for 3 years through that seasonal time, we may want to look at that. But I would get a consult with one of the tax lawyers. They could chase that down and confirm that for you before setting it up.
Okay.
But I think you're okay.
Yeah. Good question, Chad. Okay, Lee asks, Matt mentioned that a spouse's business has to be unrelated or unconnected to the one setting up a solo 401k. If I have a consulting business and my spouse's business, wholly owned by her, is one of my clients, can I set up a solo 401k?
Okay, one of your clients, maybe. Your sole or primary client, heck no. I was going to say something else, but well, we can say hell no.
Lee did put in parentheses, main client.
Main client, no.
And I opted out of that to give you an opportunity. To give you an opportunity.
If you want to see if there's any daylight. Okay, so
you're telling me there's a chance.
What the IRS rule on that with spouses is they say it cannot be even related. It can't have any relation where it's like, and we get that a lot with a spouse that has a consulting business that offers services to, the other spouse that has a business with employees. So that consulting business is cool, but if it has 100 clients and one of them, and 1/100th of the income of that consulting business happens to be that business with employees, you're probably okay. But if it's I've got 3 customers and 1/3 of my income is from my spouse's business with employees, I don't think it's going to work. Okay, it's really got to be a nominal amount of business, and really what the rule is meant for is no connection at all. That's why I give the dentist and the real estate agent example, because it's those things just don't go together. The consulting business is always a tricky one. Even someone that's well, I'm a bookkeeper, and I provide bookkeeping services. Okay, and my spouse has a construction business, and I do the bookkeeping for my spouse's construction business. Okay, do it for them, but don't charge a fee. Don't have revenue going from them. See, this is what the IRS doesn't want. They don't want revenue going from the business with employees over to the business with no employees to go to a solo K. That's what they don't want.
Okay, we'll hit a couple more questions. We're at the top of the hour, and then we'll wrap it up.
That, by the way, if you could do that, that would be the trapdoor solo K.
Yeah.
But you can't do that.
Okay, again, if we didn't get to your question, just go to directedira.com/appointment or on our website. That right, you'll see schedule new appointment. We'll get you taken care of. Shuri asks, is flipping income, so fixing and flipping properties, looked at as the same as rental income for qualifying for a solo K?
Fixing and flipping properties would be, we have our trifecta that we talk about from a business and tax standpoint in our law firm. Mark and I have talked about this for years. And all of our tax lawyers do it at KQS Lawyers. And so on your left side of your trifecta, just think of your life, go like this, cut it in half. Right side, left side. On your left side, Draw a line down a piece of paper. For many of you who haven't done this, draw a line down a piece of paper. Left side, all your operating businesses and income. Right side, investment, income, and assets. Right side would be rental properties, brokerage accounts, even retirement accounts are over there. Okay. Left side is your operating businesses, your main business, your small business, your side hustle. That's all on the left side. Flipping properties is a business. That's on the left side. Okay. Holding rentals, even if you rehab a property and hold it for rent, that's a rental thing. That's on the right side. Okay, that's investment income. So flipping properties would be business income. It's taxed that way. Now, if you just flip like one property a year, that's not going to be business income. It's incidental. You can count that just capital gain. But flipping multiple properties is going to be the left side of the equation. And there's a lot of other tax planning that goes into that as I'm talking about this. If you're like, man, I got to get my crap together on this. I don't know what the hell Matt's talking about. Get over to kqslawyers.com, go right to the homepage and get an appointment with one of the tax lawyers there and get your trifecta done. And part of that conversation can be the solo K.
All right, Ashish, you're the winner today for the most questions. This would be like the equivalent of probably an hour consult. And you got most of them answered. So we're going to give you one more since you're such a good sport. And they're very good questions. Can you make estimated contributions to a solo 401k prior to year end? For example, can I contribute estimated contributions for 2024 in January of 2024?
I have never heard of something called estimated contributions. It sounds like that was made up. And no, you cannot. Okay. Contributions are on earned income. You must have earned it. So if you're like, well, Matt, I want to max out in January of 2024.
Haven't made any money.
As long as you make that money in 2024, you can do that. And I'll say this. What's his name again? Ashish. This is an important tip here. Everybody focuses on the contribution deadline. And I like Ashish's question. He's focusing on, when's the soonest I can get the money in?
Yeah. I want to get it working.
Yeah.
Right?
Yeah. There was a report done by Fidelity that showed a few characteristics of people with large retirement account balances, 1 million plus retirement accounts. There's a few things that they did differently than everyone else. One of those things was they contributed as soon as possible, not as late as possible. If you're waiting for the deadline, if you're waiting for March 15th or April 15th of 2024 to make your 2023 contribution, you wasted almost a year and a half of investment growth. You should be thinking the other way, like Ashish. When's the soonest I can make the contribution? Okay. The only caveat there is you must have the earned income to make that contribution. Did I get his name right?
Yeah, you did.
Okay.
Yeah,
All right,
that's good. We will have contribution limits for 2024. We have a new article that we'll release along with you that tuned in live here. We'll send that out as part of our newsletter, and it'll be up on our website with all the contribution limits for solo 401ks, all employer plans, all IRAs, HSAs, ESAs. We'll get that up for you as well. Do you have a slide up for the save the dates? Did we put that in there or no? So we do have a couple conferences. You can just go ahead and save the dates. The next Self-Directed IRA Summit will be hosted in Dallas, Texas. All right. I'll have a special belt buckle that I will wear for that event. I think Matt already has one.
I do have one, yeah.
Okay. And you think you also have a cowboy hat?
I do too.
Yeah. I think Mark got that for you last year. That will be April 19 and 20, Dallas, Texas, Self-Directed IRA Summit, sdrasummit.com. And the next Alternative Asset Summit, which will be at altassetsummit.com, October 24th, 25th, 26th, and that'll be in Phoenix, Arizona, where we're headquartered at. So again, if you missed this, we'll have the replay up, directedira.com/webinar. We have the solo 401k special, and it applies to getting a custodial account, whether traditional or Roth. We'll take it off of both of them at Directed IRA. Always appreciate all your questions. If we didn't get to them, go schedule an appointment with one of our
Senior account executive?
Yeah, or a solo 401k specialist.
I don't know what we call the people that work here. One of our amazing people that works here, okay? We have I feel
they are amazing.
I feel dumb right now. Ask me a solo K question.
You want me to do another math problem?
Yeah. Okay. Well, thanks everybody. We'll be back next week with another amazing episode of the Directed IRA podcast. This is going on the podcast, and also next month with an awesome webinar. Thanks for being here, and thanks everyone for your amazing questions. We'll see
Happy
you next time.
holidays.